the Chinese government is currently facing severe fiscal strain. Across the country, tax departments are aggressively stepping up their efforts to conduct audits and pursue outstanding taxes. In this sweeping campaign, the sharp edge of the CCP's sickle has landed squarely on the e-commerce sector, a move that is causing profound distress and triggering a wave of business closures across the industry. The issue of e-commerce taxation has never generated such widespread panic as it has today. Since the official notice mandating the submission of tax-related information was issued in late October, countless e-commerce merchants have been left in a state of high anxiety, struggling to cope with the sudden regulatory shift. The official tax mandates reveal a steep escalation in liabilities for online businesses. For companies with annual sales ranging between 1.2 million and 5 million RMB, the value-added tax, VAT, rate is set at 1%. However, once the 5 million RMB threshold is crossed, the VAT rate sharply increases to 13%. Consider a typical seller generating 10 million RMB in annual sales. Under the new regime, their annual tax burden for VAT alone reaches a staggering 1.3 million RMB. This immense figure doesn't even account for other operating costs such as product procurement, employee wages, rent, warehousing, and logistics. For merchants who operate on extremely thin profit margins or deal in high-value goods where slight price changes deter buyers, this sudden tax cost pushes them immediately into an unprofitable or even bankrupt position. Reports from social media influencers and industry experts suggest that the current wave of business collapses is merely the beginning. One popular Douyin blogger indicated that a massive number of businesses are already facing failure, while many others are considering abandoning their ventures overnight. The core issue is that for years, the majority of these small and medium-sized sellers never budgeted for significant tax expenses. Now, the abrupt demand for back taxes and future payments is crushing them. Many sellers have found themselves instantly in debt due to the unexpected tax burden. A screenshot shared by a disgruntled merchant showing the tax payment success was accompanied by a bleak message: "This damn 13-point tax, all large e-commerce businesses are doomed to fail next year." The ripple effects of the tax enforcement are particularly severe in key manufacturing and trading hubs, fundamentally dismantling the long-standing low-profit, high-volume business model that characterized much of Chinese e-commerce.
He noted that as sales turnover increases, the system automatically elevates the merchant to general taxpayer status, incurring exorbitant tax costs. He predicted widespread closures, stating, "E-commerce was already tough. Before, without mandatory taxes, everyone was competing fiercely on price. Now that competition is over." He anticipates an inevitable surge in product prices across the board once the new tax costs are fully absorbed.
The impact is especially visible in Zhejiang's Yiwu, a global center for small commodity trade. Ming Sheng, who previously worked in cross-border small commodity wholesale there, has now quit the sector entirely to seek employment abroad. He reported that he knows many local e-commerce businesses that collapsed directly because of the tax demands. As he put it, their business model hinged on minimal profit margins. If you used to sell something for 10 yuan, you could make a little bit of money without paying tax. With the tax, you have nothing left. The competition is already so fierce, paying tax wipes out all the profit.
He also pointed out the timing. Properties and storefronts tied to hot e-commerce trends in Yiwu were highly sought after and aggressively purchased just months ago. Those who bought in during the peak now face immense financial peril as the market abruptly contracts. The current economic climate within China is poor, forcing some merchants to rely only on cross-border orders, particularly from regions like the Middle East.
The catalyst for this crackdown is the CCP's new regulatory framework. In June, the government imposed a requirement for major internet platforms, including payment giants like WeChat and Alipay, to systematically report the tax-related information of all operators and practitioners using their services. This comprehensive reporting mandate covers virtually every type of platform activity: e-commerce, food delivery, online ordering, online payments, and other life services, down to operations on WeChat mini programs. While platforms like Amazon and Alibaba's AliExpress only formally notified sellers in mid-October to prepare for the data transfer, the action quickly followed. Major players, including Pinduoduo's Temu and Shein Group, have already handed over substantial user data. Since November, the consequences have begun to surface, with numerous sellers receiving alerts about tax discrepancies or direct payment reminders. Media reports confirm that tax authorities in provinces like Jiangxi, Jiangsu, Henan, and cities in Guangdong such as Zhongshan and Foshan have initiated retroactive audits spanning 1 to 3 years of business records. Yang Nan, a furniture e-commerce boss in Suzhou, Jiangsu, was one of the first victims of this digital sweep. Operating on platforms like JD.com and Pinduoduo, he was flagged because the income he reported to the platform did not match the data pushed to the tax bureau. The tax bureau used big data to track the discrepancy and demanded payment. As a small-scale enterprise, he was forced to pay over 280,000 RMB in back taxes, plus hundreds of yuan in late fees.
He is resigned to the fact that prices must rise. Before, we paid tax based on the value of the invoices issued. Now, the e-commerce tax is based on total sales turnover, which feels unreasonable. Given the current environment, he believes the sector is becoming unviable. Having run his shop for 8 years, he feels regretful about stopping, but insists that, for those who survive, price increases are inevitable after the initial round of comprehensive audits.
Industry insiders and observers are unanimous in their view that the primary driver behind this aggressive tax collection is the severe financial depletion of the central government.
The tax collection now is because the state, has run out of money. It's not the tax bureau's idea. Those who understand the situation understand.
Official statistics confirm the enormous scale of the target. China's cross-border e-commerce import and export volume reached approximately 2.06 trillion RMB in the first 3 quarters of this year alone, providing a massive incentive for the central government to enforce collection. The popular overseas social media account Asia Finance noted that in theory, the government is moving towards a unified national tax base, eliminating regional tax loopholes. They also observed that tax collection has intensified across the board, even affecting individuals with overseas securities accounts trading Hong Kong and U.S. stocks since last year. The account concluded that the current window for wealth creation through unregulated internet ventures is effectively closed. Many online commentators view the tax crackdown as an act of robbing the poor to sustain the rich. They argue that high-net-worth individuals and powerful business owners possess the resources to establish sophisticated structures, such as offshore accounts and shell companies, to legally or illegally evade tax obligations on a massive scale. Meanwhile, small operators, like the merchants in Yiwu, lack such sophisticated means and are easy targets. One comment summarized the feeling: the CCP has a preference for bullying the weak. The small bosses in Yiwu don't have the capacity for complex avoidance schemes, so they are the ones who get hit. The sentiment is that the CCP, facing a deepening economic crisis, is resorting to desperate measures, effectively launching an economic nuclear strike on an already weakened populace. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.